Is Ruchit with us? All right. So Ruchit will just join us in a minute. We'll just speak to him on the technicals. Vivek Mawani is with us on the fundamentals. Vivek, thanks very much for being with us on this edition of Market Movers. What do you make out of auto sales? And I don't want to so much get into their 10% less, 20% less. I want to get into more as to what it does to the supply chain going back in terms of not just them cutting output, but the auto ancillary guy, the OEM guy, what have you.
Hi, good morning. Two things related to the auto sector, or the same can be extrapolated to a lot other sectors which have retail sales happening. What happens in November and December? Even in December, over the next couple of weeks, it seems it doesn't, the cash crunch in the system at retail level doesn't seem to be easing off even now. So November, December sales across the board at retail level are likely to be impacted significantly across the board. It's not just autos, it's not just two-wheelers, but a lot of the discretionary consumer spending also. So be it paints or be it your branded garments and jewelry and so on and so forth. But what happens in November, December and is not really a trend. One needs to see what happens January onwards, whether things ease out. Yes, it's going to be a challenging time for everybody in the chain. The sense I make of the auto numbers which came out yesterday, that probably the primary sales, that is sales from company to the dealerships, did happen in November. What is important is I would want to hear what was the secondary sales at the dealership level. So probably the inventory is today stocked up, huge amount of inventory sitting with the distributors and the chain down the line. But whether the actual consumer offtake has happened or not in the last 3 weeks, we need to get some more concrete data on that. Yes, having said that, it is obvious that 2 months this disruption is going to affect everybody else in the supply chain also. So auto ancillaries are also going to be badly hit, and one needs to see with the quarterly numbers that will come out in January as to what really has been the impact. A lot of them have very high fixed cost component, and so under capacity utilization actually results in margins actually falling off significantly. So it's not that a 10% or 20% decline in sales results in 1% margin erosion. Some of them could have actually have 4-5% EBITDA margin erosion as well.
I'll come back to you in just a moment. Just hold that thought. I'll come back to you in a moment. Ruchit is also with us. Ruchit, thanks very much for joining us. First, your view on where we are headed, because we're again heading back to a very critical support level, maybe 80, 90. And what's happening to the bank nifty here, Ruchit? Because now we are dangerously close to that 17,000, 17,400 kind of next support.
Very good morning, Ashu. Ashu, overall, first we look at the Nifty front, then 80 to 50 was one of the resistance that we were watching for, because that was 50% retracement of the recent corrective move which we had seen from 8600 to 7900, almost 7900 levels. Now the thing is that rather than just looking at this corrective move of yesterday and today, one should look at what the broader time frame charts. On weekly charts, we have seen formation of a dragonfly doji pattern last week, which is a trend reversal pattern, and the same has been formed after a correction of 1000 points, almost 900 points in the Nifty. So the broader time frame chart, the weekly charts, does not indicate that we would see significant downside in short term. So I think this correction which is there, if it comes around 8080, that should be used as a buying opportunity. In near term, probably we would again head towards this recent high of 8,250. And once that is crossed, I think the momentum would pick up again. So on Nifty front, we are definitely looking this decline as a buying opportunity if it comes around 8,080. Now coming on to Bank Nifty, this sector rather has been one of the underperformer in last 2 to 3 weeks. As of now, there are no signs that this sector would outperform the broader market index. Rather, if we see compare it with the other sectors, IT and pharma could be outperformers vis-a-vis Bank Nifty. So I think if Nifty gives a pullback move, IT and pharma could be the participants in that rather than Bank Nifty. So one should avoid going long on Bank Nifty at current levels. but around 8,080, one can look to go long on Nifty.
Right. So Ruchit, just two things that we have to look at. Obviously, none of us know what direction a market takes. Let's say it doesn't. This is not a bounce back. Let's say we do start drifting below levels of 80 and head towards, let's say, 7,600. What do you do then? Because at some point you have to reverse your buy on dips.
Yes, definitely. Also, at some point we have to keep a stop loss, where there would be indication that whatever analysis we have done, that has gone wrong. So probably if we go according to the pattern, then the 7910, which was the last week's low, that would be the crucial support now. Because usually whenever such reversal patterns get formed on the weekly or monthly chart, so that low of that candlestick pattern holds a very significance. So the selling pressure would increase only on breakdown of those levels. So even if you go long on around 8,080, you can keep a stop loss around 7920, which should be about 150, 160 odd points. Only if that stop losses get triggered, then you should look to again go negative on the markets. Otherwise, the probability here is high that this dip going on in the market should be used as a buying opportunity.
Mm-hmm. So Vivek, just going on to the banks, I want to just get away from also what the bank Nifty is doing, because they can always find new stocks to put in the bank Nifty at some point. But do you think the banks themselves are going through massive disruption? Because we saw exactly the same thing happening 10-15 years ago when brokerage firms went from physical to online trading, where margins just got completely wiped out. And I'm just wondering if banks are facing a similar disruption now, because we are moving into a totally different digital phase.
See, as far as the disruption in the banking sector is concerned, yes, there is going to be disruption, and during the process of disruption, I mean, it is never without pain. So one does have to go through that natural process of pain, and hence, speaking from a market point of view, a correction, and that correction which could be fairly deep and sharp. I mean, when I'm talking of deep and sharp, probably, I mean, I will not be surprised that Nifty goes well below 8,000, and perhaps we could be hitting 7,500 in the next few weeks to couple of months. Any disruptive event doesn't rectify itself in a matter of 1 or 2 months. So nor is the market going to bottom out tomorrow, day after, and to say that at 7,900 that we hit last Monday, I mean, that is the bottom. I don't think so. I mean, 7,960 or the whereabouts of that, I don't think so. I mean, any disruptive phase lasts from a few weeks to few months. So the bottoming out process in the market is going to also be elongated, at least for the next couple of months. We are going to see massive amounts of volatility. That's number one. Coming back to the banking sector, I don't know whether the disruption is actually going to lead to compression of margins, because what we now have is banks are flush with low-cost deposits. And actually in the near term, I mean, if economic growth and investment activity picks up and hence the loan growth picks up in the banking sector, I mean, I actually see expansion of margins, net interest margins for banks, because now they have a much larger share of low-cost deposits, the savings and current accounts, CASA deposits, where actually the interest spreads would be larger on an incremental basis. How much of the lending rate cuts get translated over the next few months, one needs to see. One also needs to see on next week when RBI has its policy meet and what announcement comes out of RBI in terms of direction for the banking sector. But having said that, I am of the firm belief that both the Bank Nifty and Nifty have a significant way to go down in the next few weeks before we bottom out.
We'll also take a look at the BSE Small Cap Index and the BSE Mid Cap Index. Again, can we look at a one-year chart also, Smita, in these two indices? So, yeah, I know these are falling, but see what happens with small and mid cap. Their fall, like the Nifty, doesn't make any difference to them. They have to reach a particular point where some of the larger chunk holders, like the portfolio managers, need to start selling. Now, why am I saying that? Let's say you have 50,000 shares sold in L&T. Nothing will happen. the market will just absorb it. You try and sell 50,000 shares of Sudarshan Chemicals and you do it for 2-3 days. I'm just using it as an example. It's going to get rammed. It's just not going to have anything to hold it. Because essentially there's no diversity of buyers and sellers in such stocks. So if we hit 10,000 on the small cap and mid cap index, then you will get straight away start getting 7,000, 6,000 levels like this. Ruchit, just your thoughts, because you can't look at small cap indices like large cap indices. Here, once the selling starts, there's almost nobody to pick it up because there's no liquidity.
It's a very valid point, Ashu, because generally when we see, especially among the mid-cap and the small-cap stocks, whenever they have to go up, then they need a good volume backup to go up. But whenever they have to go down, it's not necessary that good volume should be there. Even on lower volumes, whenever there is a selling pressure and lack of buyers, that itself could lead the stocks significantly on the downside. So as of now, see, when the broader trend of the market is up and whenever the Nifty and the Sensex would start its broader uptrend, only then one should look to get in the mid-cap and the small-cap stocks. For time being, till the uptrend is not resumed, definitely the stock-specific volatility would be there, and even on lower volumes, we could see significant corrections in the mid-cap as well as small-cap stocks. So this is not the time to get in the mid-cap and the small-cap stocks, but wherever you see a pullback move opportunity, large cap would be the leader. So stay with the large cap stocks itself rather than trading in mid cap and small caps at this juncture.
Right. And I just wanted to take your view on some of the other indices. I'm just going to put up the Nifty Commodity Index and the Nifty Metals Index if we have them, Smita. We'll just put that up and also look at a one-year chart on it, because if anything did hold up, it was really commodities. And so this looks like a beautiful chart, and actually the uptick started to come back again. And we'll put up a metals index also. Ruchit, your thoughts on the metal index and the commodity index? They've not only held up it, but they've actually have actually kind of been very, very strong from a chart perspective. And then the Hindustan Zincs, coppers, do you see that trend continuing?
This index definitely has been one of the outperformers. If we observe the Nifty Metal Index, then 200 days exponential moving average as well as 89-day EMA has been held consistently since last 1.5 years. As of now, there is no sign of trend reversal on this index. But yes, definitely we have seen that some indications such as parabolic SAR on the daily and weekly charts are indicating that now we might see a time-wise consolidation phase. We are not expecting any major correction in this stock, but after this such and swift up move, we may see some time-wise consolidation now coming in this stock. So even if you look at the heavyweights among the Nifty Metal Index, Tata Steel, Coal India, Hindalco, JSW, Vedanta, these 5 stocks which comprise about 76-77% of the Nifty Metal Index are looking a bit of sideways. So we may see some time-wise correction now coming in the metal stocks as well as the index.
Right. So again, interesting thought process, because we'll have to see how that pans out. Vivek, the question that when you do from a value perspective would be, I still don't find, let's say, a Balakrishna or a JK Tires or a Apollo Tires cheap enough, or a Maruti cheap enough to get in. So I can't use a buy on dips policy from a value investing perspective. But do you find any pocket there where you think the valuations have come to a point where you can get in? I'm not talking about 20% from whatever I was used to, but where they intrinsically are looking cheap.
Ashu, I agree with you that although stocks have corrected anywhere from 15 to 25 or 30%, they still don't look intrinsically very cheap. They're only looking cheap from a relative point of view, that, okay, it's cheaper than what it was 1 month ago or 2 months ago. That's about it. So, but finally, value lies in the eyes of the investor or the trader, how they perceive it. On a relative basis, yes, buying on decline in this market does make sense, but to expect that we are going to have a V-shaped market recovery very soon is a bit optimistic to expect. But and the last point, that you can't really catch the bottom, so buying on declines is the only way you can hopefully be close to the bottom.
Right. And on some of these stocks, of course, the question then is, whether we will have some anything sustained in terms of the index. So, Ruchit, just coming back to a lot of these auto ancillaries, because they've had a massive run, starting from Apollo Auto, Apollo Tires to JK Tires. Your thoughts on that, and also cement stocks, JK Cement, Shree Cement. Are we finally starting to see a technical breakdown here?
As far as tire stocks are concerned, we have seen good amount of correction in this Apollo Tires, C8 as well as MRF in the recent last 1.5 months. Recent up move seems to be a pullback move. There are no signs that it would this would be a resumption of the broader degree uptrend, and again we would head towards the new high. But definitely would avoid buying tire stocks at current moment. Among the cement stocks, one needs to be very stock specific. We are not because the stocks have already corrected significantly on a longer term charts. Some of the stocks such as ACC, Grasim, they are trading around their long term supports. Grasim is one of the stock that we believe that the downside seems to be quite limited. There's a good support placed around 800 rupees on a weekly chart. There's a 89 EMA as well as some reversal candlestick patterns have been seen around the support zones. So one needs to be very stock specific in this sector. Grasim would be one of the top pick, which we believe that going ahead could give at least 7 to 8% returns in 2 to 3 months of time frame.
Right. Let's take a look at where the pressure is coming from on the index right now. And MMTC, can we just put that stock up today? Bharat Financial Inclusion. I'd like to see a one-year chart of Bharat Financial Inclusion, if you may. And Berger Paints. Paints are very strong. I haven't lately seen, and actually today oil and gas, it's a very, very jagged stock on MMTC. No real trend. If anything, it's just a channel. And Bharat Financial Inclusion, my God, I mean that's a big crack. So it's not easy for a stock to recover that quickly. Also, if you can take a look at Berger Paints and Muthoot Finance. Ruchit, if you have looked at these stocks, MMTC, Berger Paints, Bharat Financial Inclusion, Muthoot Finance, actually Muthoot and Bharat Financial and Shriram Transport, most of them have had almost a 90-degree correction through multiple supports.
I think the downside could still be there in these stocks, specifically if we come one by one on the stock specific. Muthoot Finance, as of now, there is nowhere close to near the support. 273, 274 is where the 200 days moving average on the daily chart is fixed. So I think the stock may head lower towards 273, 274. Bharat Financial, this stock has been a lot. We have seen a lot of volatility in last 1.5 year in this stock. And the stock had not only the correction is 90-degree, but also when the stock had gone up at that time, also we had seen significant up move and a very sharp up move without any corrective move. Around 600, there's a very strong support for this stock on the monthly charts or weekly charts. A rounding bottom type of breakout was there around 600, and the recent low also coincides with this. So I think the stock, in case if it comes and tests again 600, 650, 640 range, that should be used as a buying opportunity. So in very short term, we are not expecting any significant upside momentum to pick in the stock, but about 5 to 6% downside could be seen, in fact, in Bharat Financials as well as Muthoot Finance.
Mm-hmm. And Vivek, we may just have time for one more thought on these non-banking financial stocks. We've seen a significant adjustment here. Do you expect that to continue? And sometimes it's not a question of adjustment. They essentially just lose their momentum. And I'm just thinking of the spreads. I remember speaking to Manappuram Finance, I think, at one point, and they said, or Muthoot, and they said the spreads were 20%. That's not even possible anytime soon now, Vivek, with so much money lying with banks.
Absolutely. See, 2-3 things, and I'll be brief now. NBFCs had run up far too much too soon for comfort in terms of valuations, and they would have anyway corrected. This has become an event which has triggered a very sharp correction. Will they come back to their highs that we saw in the last month or before? I don't think so, because some of them actually have to repair their fractured business model itself. I mean, especially the microfinance companies with the cash crunch, what kind of recoveries are they making? And with today's newspaper mentions of rumors of loan waivers, which actually discourages borrowers or actually encourages them to delay payments. I mean, hoping that there's going to be a loan waiver coming. I mean, these things actually fracture or damage the business model significantly, and it takes a long time for that to come back. So the correction in some of these companies will continue, number one. Number two, they are unlikely to bounce back to their recent highs anytime soon.
All right, let's just take a look at the index. The index is under severe pressure at the moment, as I'd mentioned. It, in fact, even started to drift down towards almost 90, almost a percent down on the Nifty. So we'll watch. But again, as far as technical significance is concerned, we're still about 20 or 30 points from that point. After that, of course, we'll see. We'll just also quickly look at the bank Nifty, because that one is under more pressure. And what is going on now is that the private sector banks, the charts are looking dangerously weak, something we haven't seen in years. And so that's the index, we'll keep our focus on. On that note, do we have any more time, Smita? We're done. All right. On that note, of course, market movers gets wrapped up. But we've got Mehul Choksi of Gitanjali Gems who will be joining us on Corporate Eye in just a moment. Goodbye.